The Monetary Policy Committee noted that the inflation is currently below the target. It is supported by a sharp fall in food inflation. Moreover, there is a decisive improvement in the inflation outlook. As per projections, there is now a greater confidence of a durable alignment of headline inflation with the target of 4% over a 12-month horizon.
Well, the Reserve Bank of India's policy was distinctly more dovish than what the market expected. Everyone expected a rate cut, but only a minority expected a change in stance as well to accommodative from neutral. Secondly, very few expected the Reserve Bank to cut both its growth and inflation forecast, even if they themselves had cut their forecasts. This was doubly a dovish delight. Thirdly, post the press conference, some in the market are veering to the view that the Reserve Bank may take the repo rate to as low as 5/4. Finally, the governor almost seemed to assure that he will keep liquidity surplus up to 1% of the deposits. That is around 2 trillion rupees. He didn't say as much, but he seemed to imply that, and that was, of course, music to the ears of bankers. Now, with that preface, let me invite four experts to give us their takeaways from the policy. I have with me Mridul Saggar, former member of the MPC, former RBI Executive Director. B. Prasanna, he heads Treasury and Global Markets at ICICI Bank. And Samiran Chakraborty, the Chief Economist at Citi, India. In a bit, we are also going to be joined by the country's biggest banker, the SBI Chairman, Mr. C.S. Sethi. But for the moment, Samiran, Prasanna, Mridul, thank you very much for joining me. Samiran, may I begin with you? Would you have read it like I read it, that the governors almost gave it away, that the terminal rate may not be 5.5, but even lower?
Thanks, Lata. We live in a world of uncertainties, so it's difficult to talk about terminal rates in that sort of an environment. But having said that, I think what I picked up from the policy is, and then governor's press conference, is that he's indicating that about 1.5% is a reasonable neutral rate. And if we juxtapose that on our average inflation forecast of about 4% for FY26, then we arrive at something like a 5.5 on the policy rate, which we believe is very much doable. If we go in the increment of 25 basis points, then it will be already August when we will be going to 5.5. So whether we will need to do a rate cut in October will depend much upon by then what kind of growth signals we are getting. My sense is that we will not allow growth rates to dip below 6%. So if there are signs that we are going there, then both fiscal and monetary policy action could be more aggressive. But otherwise, we would probably pause at 5.5 and see how the rest of the things evolve. But what we have also written in our report is that if the need be, then this is a time when RBI can go below neutral as the downside risk to growth far outweigh the upside risk to inflation.
Okay, then let me take that to Mridul. Mridul, the governor, the Reserve Bank has cut the growth forecast to 6.5. Have they cut it enough?
Lata, to my mind, the growth could fall faster than that and could hit around 6% this year. So that would be an optimistic sort of growth projection, because what we are seeing is some sort of a global shock, which is not ordinary. I mean, I haven't seen this kind of a shock after the Nixon shock of 1971, where gold convertibility was stopped. So on the trade front, this is a very, very serious issue. China has just levied a retaliatory tariff of 83%. So the currency war and the trade wars tariff wars are going to accentuate. So we do not know how the new global order will emerge, how it will get really settled, the whole thing. And by then, how much damage to the growth it may cause. So on an optimistic front, I think if we do 6% in the coming year, it should be fine. Indian economy could probably stand out among other peers and stuff. It's hard for the central bank to upfront guide a very lower growth rate because at the moment it's not in the data. So you would unnecessarily sort of influence the expectations. But I think the policy announcement in the sight of, given that you had a cumulonimbus clouds gathering, I think governor has got it right, and he has actually given a clear guidance in sort of making it accommodative in terms of stance. And he has managed the expectation without really raising the expectations too much, because markets otherwise go well ahead and crunch numbers about the policy rates, as you were saying. They will price it in the asset prices very quickly.
Then let's get to the market expert. Prasanna, what has the market priced in, and what is your own view? Would you also agree that in this cycle, a 5-quarter cannot be ruled out? Or is actually likely?
No, a lot of us have been working with a shallow rate cut cycle up to 6%, and it was very recently that we moved from a 6% repo to a 5.5%. And by the way, our outlook for today was also a 5.5% and a stance change as well. So to that extent, it was as per expectations. But then a couple of things which was a welcome surprise was a decisive method and way in which the governor communicated the change of stance, very clearly indicating what the stance means for the rate trajectory going forward. The other positive was a clear method or way in which he spoke about liquidity and the focus on system liquidity, which he has made in the statement rather than durable liquidity, which gives you the comfort that even if government balances were to be high, the RBI will take care of the system liquidity and hence the banking system surplus. And the third was his acknowledgement that inflation has very clearly come into a durable alignment of headline inflation to the target of 4%. So I think these three were the welcome surprises. And so we still believe that it is 5.5, which is where we believe they will reach by, say, August to October. And this is notwithstanding the global turmoil. And actually, to just add on to what Mridul sir's point was on asset prices pricing in fact, I do feel that the governor was as clear as you can get. And if the global volatility was not there, the bond yields would have fallen even more today.
Oh, exactly. Why don't you take us through that as well, Prasanna? What is constraining us is not the Reserve Bank's policy, but the fact that US yields, after touching 3.9, the 10-year went back to 4.5, almost 4.5%, 4.4, when the governor was making his speech. So do you think that the constraint for the cost of capital in India will not be so much Reserve Bank, but the fact that, y'all are looking over your shoulder at US yields?
So I would just say that it's not going to be a negative impact. It's not as if that because US yields are going to go up, the cost of capital is going to go up for India and Indian companies. It's just that the salutary impact of what RBI is doing, the benefit of that is not going to be fully felt till the time the global turmoil kind of blows over. And the fact of the matter is that when people are doubting US dollar as a safe haven, while I don't believe that it's a sustainable thing, but whatever is happening is giving rise to question every historical market facts and occurrences. And when that happens, and there is a lot of repricing which is happening, and we have never seen in this kind of a scenario where US dollar weaken and bond yields go up. Typically, those are the ones which benefit out of a crisis kind of a situation. But since this is possibly can be placed at the door of US, maybe to that extent, US is paying the price for it. But when the turmoil gets over, when it gets settled, we'll get the benefit. So to answer your question, Lata, I think the benefit of what RBI is doing will continue in the markets. But at the same time, you have to also acknowledge that there is some level, a little bit of uncertainty whether RBI will be able to do what it is said to do if the, the volatility and the turmoil continues the way it has been continuing.
Absolutely. Samiran, that question to you. We are now looking over our shoulder, not just to where dollar index is, as Prasanna is saying, but also what's happening to the yuan. And the yuan showed a distinct devaluation. The PBOC's fixing itself was at September 2023 levels. What's your sense, therefore, that are we in for ugly currency wars, and how does that impact India and impact policy?
So it could be pretty quick that the tariff war gets translated into a currency war, because in the Trump 1.0 episode, we saw that the yuan moved almost 14% in a very short period. So there is a possibility that we see a repeat of that occurring, although the circumstances today are very different. The extent of tariffs that we are talking of is very different from that period. Now, the question for India would be to what extent India follows the yuan movement one for one, or would we have some sort of flexibility in addressing these issues? We will not join that currency war, so to say, because what might, at least theoretically, occur is that if India does not depreciate as much, in a negotiation with US, that might turn out to be a slightly more favorable backdrop for us. So this balance will have to be struck. But at this point of time, the 40-country RER for INR is bang in the middle of the range that we have historically seen. So from a valuation perspective, we are starting off on a very neutral footing. We have the possibility to move either way, depending upon whether we need to support the exporters or we need to have a better bargaining position in that US trade negotiation.
I don't know what the negotiators are even looking at. If you looked at the way they fix tariffs, they don't seem to give a damn about tariffs or non-tariff barriers. They just want the bottom line. Don't have a trade surplus with me. Let's see what turn the negotiations take. Mridul, would you say that we are in for reasonably not just disinflationary but deflationary times? Considering that there is excess capacity in China. And, even without probably counting that, the Reserve Bank throughout this calendar 2025 is forecasting no time when the inflation will go above 4%. They have sub 4 for all the three remaining quarters. So do you think we will be in for an even worse deflationary shock?
I would hesitate to say we would be in deflationary shock. Yes, disinflationary, definitely. And we could go down below 4 for sure. But disinflationary would require a massive kind of a global commodity price fall. Today, obviously, Brent crude is trading at almost 58.5. So it looks like we are heading somewhat in that direction. But even with those kind of numbers, given the nature of the Indian economy, even if we get a negative inflation, it would be very, very ephemeral at some point. I don't see it as a sustained negative inflation coming into being. In any case, the other thing is it would add to our kind of space for the monetary policy to act. Today, we are at neutral rates, in my view, like with 4.4% inflation expectations 1 year down the line. Our real policy rate is at 1.6%, which is almost the middle of the range which RBI has given in terms of the neutral rate. But we can go accommodative from anywhere between 50 to 150 basis points, depending on how the multiple equilibria evolve in this setup.
Okay. Well, we have to come to the close of this conversation. So some rapid fire. Mridul, what is your biggest fear for India from this, ongoing trade and currency war? Very briefly.
So if the world gets divided into two trade blocks, for instance, I think it won't really help India. So we have to sort of manage this process, and we hope that in due course things get resolved, and we would be back.
No, quickly, I don't have so much time. Your biggest fear is that we get hurt if there are two trade blocks.
Yeah.
Samiran, your biggest fear, what does 2025 can hold?
Uncertainty.
Oh, okay. Yeah, that is there every day. We are so scared to even write a headline. Prasanna, what range will you give for both 10-year, for the say for the end of the year? I know it's a long time, and for the currency.
So I think currency is possibly the relatively easier part. There is a depreciating bias, Lata, as long as there is going to be a tariff war, there is going to be depreciating pressure on yuan and all the EM currencies. So while the dollar will weaken, it will weaken against the developed market currencies, and the EMs will continue to weaken against the dollar. I think that's one part. And on the bond deals, again, I think it's going to be a gradual move lower. Like I said, if there is a comfort that US market dislocation and bond deals in the US are not going to go out of the whack, then I think we can be a little bit more confident of the downward part towards interest rates. But I'm still willing to say that this quarter we will see yields heading towards 6 quarter.
Okay. Well, out of time, Mridul, sub 6% growth possible?
Possible, but at the moment baseline looks like 6 to 6.2.
Okay. Samiran, same question.
So our baseline is 6.3, but we have said another 30 basis point downside risk if tariffs are more permanent in nature.
Okay, I think then both of you are in the same terrain. Thank you very much. Unfortunately, out of time. And in any case, new questions and new issues are going to be thrown up by the hour. So we will touch base with you. Thank you very much, Prasanna, Samiran and Mridul, for giving us a quick take, not just on the policy, but also on this terribly uncertain environment in which we find ourselves. We have to go into a break. Don't go anywhere. We're going to be joined by the biggest banker of the country, State Bank of India's chairman, C.S. Citi.